In a recent interview, Aswath Damodaran, known as the Dean of Valuation, highlighted that the Magnificent Seven, which includes Apple, Amazon, Meta, Tesla, Nvidia, Google, and Microsoft, all appear overvalued, but Nvidia in particular is exceedingly so. This assessment aligns with the current valuation trends, where the Magnificent Seven's price-to-earnings ratios significantly exceed the long-term market average. Among the companies discussed, only Google and Apple have price-to-earnings ratios in the 20s. Meta's PE is around 30, but then the ratios escalate with Microsoft at 38, Tesla at 44, Amazon at 60, and Nvidia leading at a PE of 95. This highlights why Nvidia is considered extremely overvalued. These 7 companies make up 70% of the S&P 500's market capitalization, contributing 11% to its revenues and 27% to its gross profits, indicating their significant profitability and market value. The discussion also touches on the importance of going beyond PE ratios to assess a company's valuation, mentioning the discounted cash flow analysis as a more detailed method. This approach estimates a company's future cash flows and discounts them to their present value to determine the company's intrinsic value to an investor. Applying a hypothetical scenario where each of the Magnificent Seven grows earnings by 12% annually for the next 10 years with a 15% discount rate, the analysis surprisingly finds that Google and Meta are slightly undervalued and the rest substantially overvalued. When examining Nvidia's valuation more closely, it becomes apparent how stretched it is. Assuming a 12% annual increase in free cash flow over the next decade and aiming for a 50% annual return yields an intrinsic value of around $200 billion. However, Nvidia's current market capitalization is about 8 times that amount. This suggests Nvidia is significantly overvalued unless investors are either content with a much lower annual return than 15% or expect the company to grow at a rate much faster than 12% per year. To justify the current market cap in a simple model, Nvidia would need to achieve over 40% growth annually for the next 10 years. The discussion raises the question of whether Nvidia can live up to its lofty valuation over time. Despite recent adjustments in valuation as earnings and guidance improved, skepticism remains about Nvidia's ability to maintain its dominance in the AI and chip sectors indefinitely, especially as competition intensifies. This scenario paints a picture where, despite a price correction, Nvidia's valuation still appears overly optimistic given its earnings potential and growth prospects. It's true, Nvidia's recent performance shows remarkable growth, with revenue increasing by 34% in just one quarter, net income rising by 50% from the previous quarter, and an astonishing year-over-year profit growth of 1,259%. Despite these impressive numbers, the underlying message is that such explosive growth is not sustainable in the long term. This perspective is reinforced by examples like Tesla, which has seen significant growth, but acknowledges it cannot maintain such rates indefinitely. The initial excitement around Nvidia was based on expectations of continuous growth in chip sales, but skepticism arises with the realization that perpetual explosive growth is rare. Recently, AI has become a buzzword used to justify inflated valuations, potentially leading to unrealistic expectations and market corrections. Imagine if we had a real-life example of what was just described, where the excitement for a certain technology caused companies to do whatever they could to be associated with it, leading to a situation where stocks related to that technology skyrocketed without any real basis in business fundamentals. It turns out we do have a real-life example, the dot-com bubble, when the internet was the technology causing speculation and overvaluation. Companies back then were eager to present themselves as leaders in internet technology, with some even changing their names to include .com to attract investors, which on average boosted their stock prices by 74%. However, this bubble eventually burst, resulting in significant losses in the market value of these companies. This scenario is similar to the current hype around AI, where the fear is that a similar bubble could be forming, with investors overly eager to invest in anything AI-related without due diligence. Yet, the question remains whether companies with substantial, genuine advancements in AI, like Microsoft with its strong ties to OpenAI, could be exceptions to potential overvaluation concerns. When considering companies within the so-called Magnificent Seven, like Microsoft, The question arises whether its valuation, now in the low 30s multiple, is justified by its significant relationship with OpenAI. Microsoft is arguably the company most likely to develop a profitable subscription model around AI, positioning it for growth in new business areas. However, even as a long-term Microsoft investor, happy with the stock price increase, one must acknowledge that for the current valuation to make sense, a lot needs to go right, and setting high expectations could lead to disappointment. Despite widespread overvaluation among the Magnificent Seven, Aswath Damodaran still finds two of these companies potentially worthwhile investments. He suggests that for those who have never owned shares in the Magnificent Seven, but are interested in doing so, Tesla might be one to consider. This perspective illustrates Damodaran's ability to assess each company on its individual merits, despite broader concerns about overvaluation. The second company Damodaran suggests as a potential buy is Apple, which, despite its fluctuations, remains a robust generator of cash. Apple's performance often hinges on the cycle of iPhone upgrades, experiencing ups and downs depending on the impact of these upgrades each year. Damodaran views Apple as a steady, albeit slow-growing, cash generator, and considers it a reasonable purchase at its current price, alongside Tesla, for those looking to add to their portfolio from the Magnificent Seven. It's important to note that Damodaran's mention of Tesla and Apple does not equate to an endorsement over other investment options. The value of investing in Tesla largely depends on one's belief in the company's future execution of new technologies and products, such as full self-driving capabilities, the Cybertruck, and next-generation vehicle platforms. Apple, on the other hand, is seen as a more predictable investment, known for its consistent cash flow. While there's excitement around new products like the Vision Pro, their impact on Apple's bottom line may not be immediate or significant. Thus, Damodaran's perspective on Apple seems more aligned with viewing it as a solid, reliable investment, whereas Tesla's appeal may vary based on individual investor beliefs and expectations. If you enjoyed this video, click subscribe for more financial news and analysis.